The team at Technology for Hotels knows how busy you are, so we've created this concise briefing to keep you up to date on key happenings in the hotel industry. Let's dive in.
Welcome to the 5-Star Weekly Briefing, your pulse on the hospitality industry.
This week's briefing is brought to you by Frasers Hospitality, digitizing the guest journey with award-winning mobile ordering and engagement tools that drive revenue without the need for app downloads. Today is Friday, the 13th of March, 2026, and as we look across the industry landscape, there's just this truly bizarre paradox emerging.
Yeah, it's definitely a strange one.
Right, because, imagine having $2.7 billion in cash just burning a hole in your pocket, but finding out you essentially cannot afford to build a single new hotel. So we are seeing the industry rushing toward hyper-efficiency on one side, like literally squeezing every drop of yield out of existing real estate, and hyper-personalization on the other.
Exactly. It is, without a doubt, the defining dynamic of the current market. If we look at the latest CBRE report, the Australian hotel sector just hit a record $2.7 billion in transaction volumes for 2025.
Wow. That is a massive amount of cash.
It's a mountain of capital deploying into hospitality.
Yeah.
But the catalyst driving this, it isn't your standard post-pandemic rebound story anymore. The report highlights this really severe, sustained undersupply.
Right.
So forecasts are showing new hotel delivery will remain like 41% below historical levels for the rest of this decade.
Okay, so we have record capital colliding with this massive supply crunch. Let's unpack the causality there for anyone looking at their own regional development pipeline. Why exactly are we down 41%?
Well, it really comes down to this fortress of prohibitive costs. You've got construction materials, severe supply chain bottlenecks, and then just the sheer cost of debt.
Which is huge right now.
Exactly.
Yeah.
It has effectively built a moat around existing hotels. Because developers simply cannot afford to build new competitors, this supply-demand gap allows existing assets to just, reprice their room rates daily.
Keeping them way ahead of inflation.
Precisely. Brisbane is the textbook example right now. Their rates are sitting an astonishing 67% above 2019 levels.
That is wild.
It really is. It has become an absolute landlord's market if you already own the asset.
Well, I got to push back on that narrative just a bit, though, because I'm looking at the latest pricing shift data, and there's a pretty glaring contradiction. Oceania, specifically Australia and New Zealand, is actually recording an 11% decline in average rates compared to the first half of 2025.
Right.
So if rates are dropping 11% regionally, how on earth is the market simultaneously breaking investment records and, seeing a city like Brisbane surge 67%? The math there feels incredibly disconnected.
I get that. It does seem contradictory on the surface, but this is exactly the puzzle every major institutional investor is modeling right now. To reconcile it, you really have to separate short-term consumer friction from long-term structural reality.
Okay, walk me through that.
So that 11% drop across the broader Oceania region, that's essentially a localized market correction. Local travelers are feeling the pinch of domestic inflation, and as airline capacity returns, they're opting for, cheaper overseas holidays.
So that drags down the regional averages.
Exactly.
Which means the domestic operators are just fighting tooth and nail for a shrinking local dollar.
Precisely. But that $2.7 billion investment surge, that is a purely long-term structural play. Offshore capital, which, by the way, made up 78% of that total investment, they aren't panicking over a localized short-term occupancy dip.
They're looking at the bigger picture.
Right. They are targeting high-yield gateway cities. They know that the cost of pouring concrete in Sydney or Brisbane is so high that new supply is practically choked off. Once the short-term domestic correction flattens out, the sheer lack of new rooms is going to drive immense valuation spikes.
I love that. It's like the difference between trading the weather and investing in the climate.
That's a great way to put it.
And this capital surge isn't isolated to Australia either. JLL's latest forecast projects APAC hotel investment volumes to exceed $13.3 billion in 2026.
It's massive.
It is. And while Japan, Singapore, and Australia are acting as the safe havens, Vietnam has suddenly emerged as the top market for outright profitability growth. They have this perfect storm, a rapidly growing middle class, surging international lift, and an operational cost base that still allows for massive margin expansion.
Which really brings us to a fascinating strategic dilemma for owners in those developed high-cost markets. If you accept that building new hotels from the ground up is just prohibitively expensive, you can't just sit on a static asset and wait for the market to lift you.
Right, you have to do something.
Exactly. You have to actively manufacture value within your existing footprint.
And we are seeing some incredible operational creativity to solve that. Owners are essentially treating their buildings like a TARDIS.
TARDIS, I love that.
Right, trying to make them significantly bigger on the inside without ever touching the exterior walls. Like, Frasers Hospitality just announced a $140 million strategic asset enhancement initiative.
Yeah, that's a huge project.
It is, and the standout there is the Novotel Melbourne on Collins. They are somehow adding 72 brand new keys entirely within the existing building envelope.
Which requires an absolute masterclass in spatial engineering. I mean, they're completely rethinking the real estate.
Yeah.
By auditing back-of-house areas, optimizing dead hallway space, modernizing floor plates, they're driving massive uplift in RevPAR.
Just extracting more revenue out of every available room.
Exactly, and without pouring a single new foundation.
But, I noticed a massive chunk of that $140 million isn't just going to extra beds. It's being poured into MEP upgrades, so mechanical, electrical, and plumbing.
Yeah, and those upgrades, they are no longer optional. Institutional investors are operating under incredibly stringent ESG mandates right now. Environmental, social, and governance.
Right.
So if your building isn't energy efficient, if your HVAC systems are leaking carbon, your asset is rapidly becoming uninvestable. Upgrading the MEP future-proofs the building for institutional buyers who just cannot put brown assets into green funds.
That makes total sense. And alongside this internal optimization, there's this massive pivot toward what the market is calling the Heritage Plus trend.
Oh, yeah.
Since you can't afford to build new luxury, you just buy old history and modernize the interior. Take the Amora Herencia Riverwalk, Melbourne. The Sirafitrawan family acquired a heritage-listed former tram depot on Bridge Road.
Such a cool space.
It really is. They retained the historical shell, entirely reimagined the interiors, and carved out 45 newly designed rooms to bring the property up to 156 keys.
And the psychology behind that strategy is brilliant. You cannot manufacture the authenticity of a 19th century tram depot.
No, you can't.
It gives the property an immediate soul.
Yeah.
And for the high-end corporate and leisure segments, that historical authenticity commands a premium rate that a generic glass tower simply cannot touch.
We're definitely seeing domestic heavyweights recognize this, too. Salter Brothers Hospitality, who are already one of the largest hotel owners in Australia, just made a huge move. CEO Tash Tobias is launching a dedicated heritage-rich brand called Ardour Hotels and Resorts.
Yeah.
They are immediately rebranding Milton Park and Lilienfels under this new banner.
Which honestly represents a significant shift in the power dynamics of hotel management. Historically, an owner like Salter Brothers might acquire a property and immediately pay a massive global operator to, fly their flag on the roof.
Just hand it over to a big chain.
Exactly. But by launching Ardour, they are bypassing the global chains entirely. They're moving to an agile, owner-aligned management model.
Meaning they keep the economics in-house. They aren't bleeding out double-digit franchise and marketing fees to an international brand.
Right. And more importantly, they are building a proprietary tech platform to own their guest data. They are betting that a homegrown, heritage-focused luxury brand can compete directly with international boutique labels by offering something deeply localized.
So, that is the playbook for existing assets. But on the rare occasion developers do decide to break ground on something new, the strategy has completely mutated.
Oh, absolutely.
We really aren't seeing standalone, single-use hotel towers anymore. The risk profile is just way too high. Instead, developers are building these mega precincts. Investors aren't buying hotels, they're buying entire self-sustaining ecosystems.
You have to. You need diversification to survive the current economic climate. A standalone hotel is entirely dependent on nightly occupancy. But if you build a precinct, you spread that risk.
Case in point is Sydney-based One Global Capital. They just finalized a site acquisition in Five Dock for a staggering $1.5 billion precinct. Led by Iwan Sunito with architecture by Koichi Takada, they're calling it a city within a city. So they're taking a 150-key hotel and weaving it directly into 5 residential towers containing 750 apartments, extensive retail space, and a build-to-rent ecosystem.
Let's break down the financial mechanics of why that works so well. The retail leases and the stable residential rents provide a baseline of cash flow that subsidizes the cyclical risk of the hotel.
Makes sense.
And conversely, having a premium hotel's amenities like housekeeping, spas, high-end dining, physically attached to the residential towers, That elevates the sale price of the apartments.
Oh, wow. Yeah.
Add in direct metro connectivity to the CBD, and it just becomes the ultimate defensive real estate play.
The appetite for these strategic plays is driving rapid-fire acquisitions across the board. Brookfield Asset Management just executed a textbook example of active asset management, dropping 250 million New Zealand dollars to acquire Ridges Wellington and Sofitel Queenstown.
Achieving a record price per key in Queenstown along the way, I might add.
Yeah.
And active asset management means they aren't just parking capital. Brookfield is going to deploy their global resources to aggressively revitalize those properties and capture the rebounding high-end international tourism dollar.
The Abu Dhabi Investment Authority, ADIA, also made waves, selling the Novotel and Ibis Sydney Darling Harbour complex for $390 million. And the genius of this acquisition for the buyers is location.
Always is.
They are perfectly positioned next to the $2 billion harborside redevelopment. So why absorb the risk of building a massive tourist attraction when you can simply buy the hotel adjacent to the attraction someone else is funding?
It's a classic infrastructure coattail play. You just ride the wave of surrounding civic investment.
Exactly. We also saw Minor Hotels acquire the Oaks Lake Krakenbach Resort in the Snowy Mountains this week. And alongside that, Minor International confirmed they are launching a hotel REIT, a real estate investment trust, by mid-2026. This is designed to facilitate an asset-right expansion strategy across Asia and Europe.
An asset-right strategy is absolutely crucial for global operators right now. By creating a REIT, Minor can sell the physical real estate of their hotels into the trust while retaining long-term management contracts.
So it moves the heavy, expensive real estate off their balance sheet.
Exactly, freeing up immense capital.
Yeah.
They can then take that capital and focus purely on what generates the highest margin operations, brand building, and tech development.
Which provides the perfect bridge into our next discussion. Because managing the physical real estate, the bricks, the mortar, the heritage facades, that is only half the battle in 2026. The real war, the one defining operational success right now, is being fought over digital real estate.
100%.
Properties now have to own the guest relationship, and the industry has really rallied around a new metric this year, the personalization gap.
And this is perhaps the most critical indicator of a hotel's digital health today. Guests are demanding what we call Amazon-level personalization. They expect the property to know their preferences, anticipate their needs, and customize their stay before they even walk through the doors.
And the data shows this isn't just a nice-to-have, it is a massive revenue driver. Properties that successfully drive their OTA dependency, meaning their reliance on online travel agencies like Booking.com or Expedia below 40%, are seeing RevPA premiums that are 8 to 12% higher than their competitors.
The logic there is really simple. He who holds the data holds the power. When a guest books through an OTA, the hotel rarely gets the behavioral data. You just get the transaction.
Just a name and a date.
Exactly. And without the data, you cannot personalize the experience. Without personalization, you lose the ability to upsell customized packages, and you basically cannot build direct loyalty.
Hilton is attacking this data gap aggressively. They've just launched a beta version of their AI planner on Hilton.com. It is essentially a generative AI digital concierge embedded straight into the booking engine.
That's a huge move.
It is. Guests can use natural conversational language to explore destinations, compare specific properties, and build complex itineraries right there on Hilton's proprietary channel, keeping the guest entirely off the OTAs.
This transition in technology was actually the dominant theme at the AICENN Tech Summit in Singapore this week. What's fascinating is just how rapidly the capability is evolving. We are moving past generative AI, which, simply writes a nice welcome email or suggests a nearby restaurant, and entering the era of agentic AI.
Okay, let's clarify that distinction for the listeners because it's a huge leap. How does an agentic AI operate differently within a hotel tech stack?
So generative AI takes autonomous action.
Okay.
At the INN Tech Summit, developers discussed AI acting as a literal financial guardian for the guest. Once a booking is made, this agentic AI continually monitors prices in real time. If a better package or a combined flight and room deal becomes available, the AI can autonomously execute a rebooking on the guest's behalf. Yeah, all while actively scanning for and blocking booking scams. It's an active, autonomous agent working right within the ecosystem.
I can only imagine how terrifyingly efficient that is for revenue managers to deal with, but the financial upside for hotels getting their own AI right is staggering.
Oh, it really is.
The Boston Consulting Group just released a report noting that the 25% of hotels successfully AI scaling, meaning they have fully integrated these tools, are seeing 15% RevPAR gains purely through real-time dynamic pricing.
To put that in perspective, realizing a 15% RevPAR gain without adding a single new room, without renovating a lobby, and without increasing your marketing spend,
Yeah.
that is pure operational leverage. It drops straight to the bottom line.
But there's a massive hurdle. That same BCG report noted that 56% of regional executives are completely paralyzed by fragmented infrastructure.
Yeah, the silos.
Right. You can buy the smartest agentic AI on the market, but if your property management system cannot communicate seamlessly with your point of sale system and your customer relationship manager, the AI is effectively blind. It's like buying a state-of-the-art supercomputer and plugging it into a dial-up modem.
That fragmentation is the defining digital divide of 2026. If a guest's dining preferences live in one silo, their booking history in another, and their spa appointments in a third, true hyper-personalization is just impossible.
Which forces us to ask a rather profound question about the future of this industry. If agentic AI is going to flawlessly handle the dynamic pricing, the booking journey, the itinerary planning, and the upsells, what is the actual role left for the human on the ground?
That is the existential challenge for hospitality right now. If the transactional elements of a stay are fully automated and friction-free, the human element has to elevate.
It can't just be transactional anymore.
Right. It can no longer just be about checking someone in. It has to become about cultural capital and deep localized engagement.
And we saw a brilliant execution of that concept this week. IHG Hotels and Resorts signed a landmark partnership with the Bangarra Dance Theatre, an acclaimed First Nations performing arts organization.
Yes, a fantastic initiative.
Matt Tripolone, the MD for IHG Australia and Pacific, and Louise Ingram from Bangarra are spearheading this.
This partnership is the perfect blueprint for the future of human hospitality. It marks a deliberate shift away from purely transactional, points-based loyalty. I mean, any algorithm can offer a free breakfast or authorize a late checkout.
Exactly.
But facilitating a deep, values-based connection to the land and the local culture, and AI cannot generate that. Partnering with Bangarra offers guests a profound cultural narrative that elevates the hotel from a mere place to sleep into a cultural conduit.
Guests are increasingly demanding that experiential premium. We're seeing this values-driven leadership recognized across the board. Like at the 2026 Accor Pacific Awards, COO Adrian Williams heavily championed ESG-led operations.
Very important focus there.
Absolutely. While Pepper's Seaport Lawn System took out Hotel of the Year for operational excellence, properties like Ibis Sydney Barangaroo, Mercure Alice Springs, and Pullman Auckland Airport were specifically recognized for responsible hospitality and social care.
It just proves that ESG is no longer a begrudging compliance checklist. It is a core driver of brand equity. Guests actively want to spend their money at properties that align with their personal values.
And executing this shift, from digital agility to cultural depth requires an entirely new playbook for leadership. Looking at the talent moving across the board this week, the major players are quietly positioning their heavy hitters to execute it.
Yeah, some big moves this week.
Neil Jones has just been named president of EMEA for Marriott. Over at Hyatt, Mark Hoplamazian has officially taken over as chairman of the board, signaling a real consolidation of strategic vision there.
Pan Pacific is also bolstering its senior team for an aggressive global expansion phase. They've brought in Craig Bond as Chief Operating Officer, Celine Du as Chief Commercial and Marketing Officer, and Kate Lowe to lead development.
And down at the property level, the folks actually executing this daily are stepping into massive roles. A huge congratulations to the new general managers and leaders this week. Faris Ahmad with Accor, Michelle Taylor taking the reins at Fairmont Blue Mountains.
Well deserved.
Henry Tran moving into the night manager role at Accor, Eric Anaheim as pre-opening hotel manager at the EQ Hotel, Aaron Proud taking over Merivale's new boutique property, The Whale, and Julia Wardle stepping in as director of sales and marketing at Emporium Hotel South Bank.
Seeing that level of operational talent moving up through the ranks is exactly what the Pacific region needs to navigate this complex transition.
And their peers globally are just as busy. Keep an eye on the international radar, you guys. One Hotel Tokyo has officially debuted, marking a major luxury sustainability entry into Japan. Club Med Borneo starts taking bookings this month for their new Saba resort.
This is going to be a stunning property.
Oh, for sure. Oakwood Premier Raffles Place is confirmed for Singapore. IHG's Holiday Inn Resort Kuokata is pushing into Bangladesh's coastal sector. And Accor's ultra-luxury hotel at sea, the Orient Express Corinthian, is gearing up for its maiden voyage.
The sheer scale and diversity of that global development pipeline is just a great reminder that despite localized supply crunches and inflation, the fundamental human appetite for travel is only expanding.
It certainly is. Now, before we wrap up today, I want to leave you with a final thought to mull over, especially regarding all the AI and personalization we've been discussing. We talked extensively about algorithms and data driving these massive 15% RevPR gains, but keep a very close eye on the UK right now.
That's right, the CMA.
Yes, the Competition and Markets Authority has just launched a formal investigation into Hilton, IHG, and Marriott regarding data sharing via third-party benchmarking platforms. If regulators decide to wall off regional data sharing to prevent algorithmic price fixing, how will that impact the AI engines driving your revenue strategy? It is something to seriously consider as you evaluate your own tech stacks and data dependencies this week.
That wraps up this week's 5-Star Weekly Briefing. Thanks for tuning in and staying informed with the latest in the hotel industry.
Don't forget to check out our 5-Star Conversations podcast, where Brendan Granger from Technology for Hotels sits down with the industry's most influential leaders to uncover their journeys, insights, and the future of hospitality. It's a must-listen for anyone passionate about elevating their guest experience and driving innovation in the hotel world.
Until next time, stay well and stay ahead. See you next week.